munyemerere tugaruke kuri pariti yacu ya nyuma ariyo yo kureba uburyo financial reports zikorwa nyuma y'uko tubonye source documents zose, nyuma y'uko tubonye kandi data z'ibanze, ubu noneho hakurikiyeho kureba uburyo report ziba produced. Financial reports ziba produced gute nyuma y'uko tubonye données z'ibanze kugira ngo tube twabasha noneho kubona financial reports. Twibuke ko turi muri IFRSs, under IFRSs, under the National Public Financial Reporting. Munyemerere nk'uko nabibabwiye ko byiza ukorera muri Excel, twibukiranye ibyo twabonye by'ibanze. Twabonye muri source documents cyangwa se prime entry books. Yes, twabonyemo sales, tubonamo cash, bank, ibintu byose niba muri sales tubibonamo, biba muri purchase nabyo turabizi, receipts ni prime books zidufasha kugira ngo tube twategura financial report zacu. Hanyuma iyo tumaze kuva muri source document, accounting source document, ikiba gikurikiyeho ni analyzing data entry, journal zavaho tukajya muri journal. Iyo turangije journal tujya muri ledger ari list of all accounts. Yes, ledger, it's a set of all accounts. Trial balance kaba set of all accounts balanced. Byose kuvuga ngo iyo hagize dokima iburira cyangwa igapfira muri source document kiba ari ikibazo. Twibukiranye ko cash and zino zose ni journal. Izi mureba ha zose, izi zose ni journal entries ziba zavuye muri accounting source documents or prime entry. Ibi ngibi umukontabule aba agomba kubimenya. Let us move. Now we're going to after analyzing all those data and their double entry rules being obeyed and being entered into the ledger, the next step is to produce statements, financial statements. Now, allow me to start on statement of profit and losses and other comprehensive incomes. Under profit statement, we have sales revenues. Those sales revenues, what we do is to make sure that all receipts have been entered. Remember, let me scroll down as well. Let me split these things so that we will be able to remember at which time we are just using. Yes, which time are we just using for us to be sure and certain without bias. Without bias. Very good, very good, very good. Right. Now we can continue. It's okay. Now, you see, after understanding all those source documents, we can move on in statement of profit and loss on the other comprehensive incomes. Or you can say other income, no problem. Sales revenue, which comes from goods or services. Remember here on our case at which we have finished to see, it was the case of selling automobile goods. So it's a good producing, it's a being good producing business. Now, on our net sales, to get on our net sales, we have to take sales, yes, we add service income if it's applicable, interest income. If we have, for example, like rent income or financial income, we have rented someone amount and they give us the interest. We have rental income if we have house to rent, commission income if we have done a service to someone and he gave us the income. All of those consolidated incomes are being added together, move or to subtract. Is it net sales? Net sales, no, sorry, return in words or sales return. Sales return, being sales return is in the case that we have sold something to a customer or a goods or a service, and he brought back a claim that he was not satisfied or goods were damaged. Those we have to remove automatically. There's income. As you have seen here, we have seen that we have to subtract. Remember, why did I carry this date, my friend? You remember in chapter on part one, we have stated that uh, there is a starting an accounting period start from 1st of January to 31st of December. Between this gap, we have all of the years, all 3 years days are here. Are here. The way I have managed it to spread out is that all transaction through here should be well recognized up to up to 31st of December. This is where we have to end our accounting year. Accounting year usually ends by 31st of December. You see? Yes. That is what I have done. That's why I'm just showing you where everything should be coming from. If you are doing in a small business or a big one, no problem. Whichever industry you may be working in, it is easier for you to ensure that all transactions are being recorded through the year. Now, what we have to do only is that at the end of the day, the last day of the year, every transaction should be recorded, ensured that net sales are calculated under that form. For example, it's a simple example. You have sale of 1 million, we have 10 million US dollar, for example. Yes, it should be recorded as net sales if there is no any other transaction. But when there is a return of let's say 5,000 US dollar, you see, we remain with 5,000. Or when it is one, to ensure your formula is clear. You see, everything should be updated themselves when you have just entered your formulas very clear. Now, this is the part number one. Part number two, cost of goods sold. You see, we have opening inventory. We have purchase. We have this consists of direct expenses. You can add them together. Yes, you add it together. This comprise the what? The total direct expenses. You see? Then here also you end. Now, let's say that you have carriage inwards or wages and custom charges, royalty, production based, special design or drawing costs. All of these will be not direct expense, but will constitute something that we have that we call total. Sorry, I'm sorry. I'm beg my pardon. I'm sorry. This is not such a one, but we have to ensure that all of those costs here, from starting from this one to carriage inwards, return outwards, or purchase returns, also we add them. Yes, up to here. For example, the aim of this template is to show you ways of calculating them. Now you add them together. You add them, all of them together. That's what you have to do. So this is the template I'm showing you. Allow me to, you see, now you make a total that I'll explain it here. Good. Now, what you can do also is it to total cost of goods available for sales. Remember, we have opening, inventory, then you state all of these. Yes, you see. Now, suppose we have an inventory of that amount. Yes. Cost of goods sold, that's where we take opening inventory or stock, we add direct expenses, then we less return outward, and we subtract what? We subtract closing stock. The closing stock is here. You see, the closing stock is here. Now, you are done with your gross profit. Gross profit will be equal to your gross profit will be equal to net sales here minus total cost of goods. Now you are done with gross profit. The next thing is to see other operating income. Gross profit, you add other operating income. And here you see them, yes. Other operating income. The discount received, yes, is added. Yes, you see commission received, gains from operations. Now you get net profit. Your net profit, you add gross profit to other operating income. Then you subtract, but after realizing them, you subtract your you receive all the incomes after being reduced from all of those expenses or operational expenses. Those you get amortization, total operating expense, other comprehensive income, net profit from operations. Now, this is where you take. Remember, first we have seen. We have to consider everything. Gross profit, yes. Now, you remove this. You can add. You add other incomes. Here, you add other incomes. You have other incomes. You see, now you have other income. other operating incomes, yes, which is here or here and here. Then, yes, you see, yes, gross profit, other incomes. Yes, now you subtract total operating expenses. Those you come up with your net profit. It's the same as income tax expense. You subtract. Remember that the CIT here in Rwanda, it was reduced from 30% to 28. To 28. Let me bring a clear color so that everyone can see. Now, statement of changes in equity. That is number 3. We have opening balance of equity if there is, opening share capital, opening reserve, opening retained earnings. We add treasury share to be issue. Now we subtract treasury share purchase. What you get is the total what? Total operating opening, total opening, because all of those are openings. All of these are opening. Now you come on with opening balance equity, which is total here. We come to comprehensive incomes. We have profit or loss, other comprehensive income if there are. Yes, we see total comprehensive income. Now, after getting, you come up with total comprehensive income by just adding all of this. I will share with you the template, the statement of financial position now. You see, we start by assets, non-current assets, property, plant, and equipment. These are physical tangible assets used in operations. We have office equipment, furniture and fittings, machinery, leasehold improvements, motor vehicle, construction in process, tools and equipment, and leasehold improvement, motor vehicle, fixture and fitting, revaluation gain. All are the type of non-current assets. All of these are non-current assets. You see, purchase the goodwill is to compute purchase the goodwill or acquire the goodwill, which we take purchase price less net assets. When it is recognized, yes, positive goodwill occurs when purchase price is greater than net assets. Also, we have patent, legal right granted to investors. Yes, all of them are intangible, non-current assets. Trademark, brand names, logos, symbols, copyright, over creative work, license. All are non-current intangible assets or intangible non-current assets. Yes, those you add them together to come up with total. To come up with total what? Total intangible non-current assets. You add all of them. Good. Now we move on long-term financial investments. Those are investments held for more than 12 months. We have share equity investment. We have bonds, debenture, government securities, investment in subsidiaries, investment in associate, joint venture investment, long-term deposit, investment property, if held for rental or capital appreciation. Here, also we add all of them. Those we make a total. then we move forward. This is a template you can do by your own to ensure that your business is doing well, is being managed well. Land held for appreciation, boarding rented out to others, livestock, cattle, sheep, goats, plantation. Those are under IAS 41. Yes, IAS 41. Long-term loans receivable, hire purchase, all of those things you have to ensure. Now, we are done with total non-current assets, which is equal to, you add them together. Yes, does not think of formula. Now, we go to, those are current assets now. The current assets management is well maintained. Also, you have to ensure that they are clear. Yes. You start by cash and cash equivalent, cash in hand, cash at bank, petty cash, bank overdraft, only if positive bank balance. Because when it is negative bank balance, it is treated under current liability. Yes, short-term high liquid investment, treasury bills. Now we go to total cash and cash equivalent. You see, you add all of them together as well. Yes. You add all of them together. Those trademark and other receivables, yes. Now, these are also total trade and the other receivables, if there are, yes. You add all of them together as well. You see. What else? You come to inventories, stock. You take work in progress. You add finished goods. You add the goods for sale resale. You add the spare parts and the consumables as the business to which you will be using is for um, spare parts, yes. Now, short-term investment, marketable securities, share held for trading, you bonds, short-term, treasury bills, commercial papers, money market instruments, total short-term investment, yes. Total short-term investment, you add all of those short-term investment or marketable what securities, you add all of them together as well. Now, short-term loans and the advances. You go to short-term loan and advance, you see advances to employees. When there are employees you have given money in advance, you add them together. Because we have limited time, I will show you the formulas only and you will just move on by your own. Just you have to see. Now, tax-related assets, yes, you see, when there are tax-related assets, income tax receivables, VAT recoverable withholding tax. Yes, anyway, the government withhold their tax, you add them to tax-related assets, yes. Yes, you add it together. Okay. Now, the total tax related assets. Now, there is something that you have to understand that deferred income under short term, total current assets. Here you add, by adding total current assets, you will ensure that even these have been recognized or added. Total deferred revenue revenue and other related revenues. Then you add them together as well. You see, by adding this, you ensure that nothing is forgotten while designing your formulas, please. Trade payables, something that called trade payables is crucial as well. You have to ensure that they are well kept. Now, trade and trade payables, you add them. Remember, we have trade payables, bills payables, supply outstanding. All of those are total trade and payables. You add them as well. Accrued expense, outstanding expenses. Accrued salaries and wage, accrued rent, accrued utilities, accrued interest, accrued professional fees, or accrued tax. You will see in your business what concern to or transaction being done in your business only are being recorded there. Yes. Now you add all of these elements together within your worksheet. In your worksheet, you add all of them. You only consider the transaction which you have done in your station. For example, when there is no accrued professional fees, you will write here 0 or ignore it, no problem. But if you have any other, like $550 US in accrued rent, we add them. Then they have to be presented here. Yes. No problem. At the end of the year, remember 31st of December, they have to be presented. When you enter through here, now, yes, we have also what? We have current portion of long-term debt. Yes, if line of credit, short-term borrowings, there's a short-term borrowing, bank overdraft. Remember, this is negative because we have seen a price on a price if negative. Yes, now and also you add them together. Yes, you see we have income tax payable, tax payables, yes, are a part of those expenses. Remember, we are there, the income payables, payable, withholding tax payable, social security contribution payable. If you have any one of these, you also this one is just shocking us, bro. Okay, we just continue. Our studio is amazing. Our working person is not familiar with me. They are just challenging. Now we add all of those together so that you can have a common total tax payables. After this, we see unearned or deferred revenue, unearned or unrealized, or unrealized. The revenue, yes, unearned income. We have seen them. Okay. If you have any unearned revenue, add them as well. Then you come up with a total. Provision. Those are provision for tax. Yes, provision for tax, provision for bonus, provision for warranty, provision for litigation. If they are in a short-term period, also you add there of these provisions so that you will come up with total provision of short terms. We might have other types of payables. We have dividend payables, interest payables, commission payables, rent payables, insurance payables, utility payables. All of these, we add all of them together and we make also a, a total of as it is here. We come up with what? With payroll liabilities. If you have salary payables, you didn't pay your employees. You didn't pay your employee benefit payable, pension contribution, you didn't pay them. If you do not have them paid already, we have to recognize or report them as they are payables as well. Then you make as total. We have current portion of long-term obligation. Yes, you might be having a long-term loan, but within there's a long period, there are due within this year. When there are portion you have to pay in this year, they should be recognized as well as part of current liabilities. Now, you add all of them as well. Add all of them as well. You might be having other current liabilities, customer deposits, for example, the refund liability, advance from employees. You might be having work the employees before you have contracted with them. You might be having a refund liability, advance from employees, short-term provision, outstanding expenses. Those are general. Now also you recognize them under the miscellaneous or other current liabilities. Then you make summative. Then you make a total of all of those current liabilities we have from 1 to 0, from 0 to Z. Total current liability, you see where they are starting. You go and add all of those total. Total 1, total B. Yes, you come to this point, to this final point, then you make an add. Yes, you come to an non-current liability total, which is to be summative there. Thus, you add them. Now, after making total liability being recognized, we go to the another part, which is the equity. Long-term borrowings and current liabilities. We go to short long-term total current liability. We finish them. We go to now non-current liability. We add them as previously in the other assets. What you have to ensure is that every segment should be recognized here. Because I was showing you the template, the way it is being done in the long-term bank and loans. We have you do not have to be weak. You do not have to be weak. You work for as you have time, you analyze and add them. Because after doing this template, you are almost done. You are almost done. Because provision, the tutorials and the ability, yes, you have this one independently. but you will be remembering to say what it is not what is it has no other element. This deferred tax liability has no other element. You remember to put it another as a separate entity, as a separate set to be reported as a single set because it has no other subsidiaries to be aggregated together. Good. Now you come again on the provision of long-term warrant or of long-term which are for bigger than 1 year. For example, we have provision for warrant, yes. We have provision of litigation, provision of environmental restoration, mandate social responsibility, provision for the commission. Yes, you can add the provision for depreciation. Yes. Yes, you can add provision for depreciation. Yes. But it will be recognized in cash flow. Depreciation is counted in cash flow. Now, pension and employee benefit obligations. But before we move there, we have to make summative arrangements so that everything will be well recognized, please. Pension and employee benefits is another thing you not have to forget. Then you add all of them. After doing this big workflow, nothing will be challenging you now. Because you have already done a big job here of doing your formulas and arranging everything to be sure that nothing is ignored in your walkthrough. Your spreadsheet is clear and your report will be clear as well. Because nothing is adding and subtracting only. Because when you have analyzed each independent, we will see under working. Because every single element here has its own working, we will see them in a later advanced accounting. But here I wanted to show you the form at which we are just going to use through this course. Now, other long-term liability, long-term payable, security deposit, receivable, all of those, you add them as well. What you have to do by starting formulating your formula praise is only adding. You only list, you only list, you add what is being added, and now additional information will be telling you what to add, what to subtract. This helps you in understanding where you are working and analyzing them as you are the one who is working there. Now, you see we have share capital issued. Capital, yes, you add them as well. That is the first thing you have to do while doing your spreadsheet. Yes, we add all of them together. Now we go to the retained earning. Accumulated profit earned over time, including current net profit. What amount of it? We raise dividends paid here. What you have been listed should be most of the time negative. Yes. Then we add the adjustment that increase profit, and then we raise dividends. We raise adjustment that reduce profits. Yes, if there is. If there is any adjustment that reduce profit, you reduce it. Then you make a total as well. Good. After doing this job, also you come to reserve net retained earnings. Now we come to reserves. Reserves, general reserve, we have capital reserve, legal statutory reserves, and redemption reserves. If there is, you only add them. You only add them together. Revaluation surplus. Assets market value. This you do what? You raise, you subtract. If you have any, then what you have to do is doing this. Because this is a template I'm showing you. You see, we have 100 francs, but in our case, we have US dollar. The only intention of me is to show you the working. Now, other comprehensive income, if there are foreign currency translation reserves, yes, you can do what you have to do only is to analyze if there is anyone that will reduce your balance. Thus, otherwise, you only add and ensure that you have a great formula that protect you from error. Now we come to other comprehensive income. Yes, comprehensive income, total the comprehensive income. Yes, it is here. We have you we after getting this total the comprehensive income, we raise treasury shares or own share. Now you have to remember that to raise this and add this if there is. Yes, good. Those total equity will be varied at after inserting all of the formula. Contribution surplus. The way I put this one was to ensure that for my formula is well written. I said, wow. Now, because with this less, you less you put you can even put a negative sign so that we remember that you have to remove what you have to remove there. Contributed the surplus capital contribution. Yes, you add the additional owners contribution, total contribution. All of those total contribution, you will be just adding them. Now, other possible equity component, if there is, you add, then you come up with total equity. Total equity, you add all of those segments with summative alignment or that those that are being highlighted. You see, net revaluation surplus. Those I have just mentioned here. Yes, this is total reserve. Yes, yes, you see the net retained earnings. Yes, you see total share premium. Everything is now recorded as it is. Now we come to the statement of cash flow. Yes, you see, if there is a total operating activities, what you have to raise, you raise it. Yes, you raise what you have to raise as total comprehensive income. Yes, you add them, transfer between reserves. Yes, you might be having transfer between reserves. Yes, then you add all of them, then you total operating activities. This is the key element here, is to get your total under operating activities. Remember, we have operating activities, investing activities, in the financing activities. Now, in the financing activities, you will have to make also total investing activities is to be added. We'll make a summative arrangement of all of these things. Ensure that formula is accurate is one of the most thing that is important in your financial report. Under private institution, data say this caused in the public, the accounting sector, we have these their own analysis of there. Okay, there is their way own format because they are not business making profit. Now we are in a private making business that's a make profit making institutions. Yes, under IFRS, of course. We have now after in financing activity, after investing activity, go to finance. We finance, I have told you earlier that in financing activities, we might be having starting in our format, we state by operation. But remember, there might be a case where by we have started our operation on loan. For example, let's say on loan. Then after getting a loan, we invest for repaying the loan. By means that that's where the financing activities will play the role here. But if we start by getting loan, by investing ourselves, we start by investing. The activity starting the business was investing. Always the activity starting the business is to invest because you can't operate without investment. But remember, for us to ensure the clearness or going concern concept, keeping in mind the business is in there for unforeseeable future period. Means we have to start by operation, you invest, then you finance. Don't ignore it under this operation, except unless under indirect method. Because this is direct method, which is the easiest, but we may be having the time whereby we can start by investing or by financing. The activity starting the business or are possible. But to ensure that going concern concept is greatly understood by shareholders and the management of the business, it's better for you to start by operation so that the going concern concept is under very good status so that investors are happy. So I'm happy that you have seen we have moved through or after getting that, we got closing equity, opening equity, plus operating changes, plus investing changes. Yes. Now we add finance changes. You see this one. For you to better understand this thing, my friend, ensure this. Yes. To get closing here, you get opening if there is. Do we have opening? Opening, yes. If don't have opening, yes. We start by operating, total operating, yes, it is here. You add total investing, total changes, investing, if there is, yes. After computing, total financing, this is your closing. Means any changes will be resulted by here. And remember to put it aside here through the year. Because after on the 31st of December, this is the 1st of January. On the 31st of December, you will be seeing this. And after analyzing everything, you will make now total, which is the overall total. Overall total through the year. Yes, this is the overall total of the year. Good. Now you get your own name. The last thing which will be discussed in that chapter, my intention today to make sure that you understand this format, then we go further. Our session is taking longer than I expected because of explaining the formula, but now let us see. Introduction to Financial Accounting. This is our course we were in. We have finished to see our statement of full cash flow. As I told you that we will be first thing the format to which we have to use. Now, operating activities, we have 2,200 US dollar. Yes, remember, we add adjustment, increase in an unearned or unrealized profit. We add increase in account payables. We add the increase in prepaid insurance. Yes, increase in account receivables. Why I have told you that those prepaid insurance is as an asset. Increase in account receivables all are assets. So they are the why we subtract them in operating activities, they are not under this period of time to which we are calculating. We have received the revenue from other operating period. You get the why? Here we misread ourselves if we add. That's why we subtract them here. Now we get net cash used by operating activities, which is one. Purchase investing activities, we have three. Yes. Purchase of truck, we have three. Yes. Net cash used by investing activities is 6. Now, financing activities issued share, we have 10,000 US dollar, as we have seen, borrowed from a bank. Do you remember where we have seen all of this data? Yes, let me show you. Yes, equity. Let us back on the point where we have seen everything. Yes. Good. We have 100 shares which were issued. We have 200 which were dividend. Now, to be sure for every single element, yes, now here we come to yes. 2. You have seen there's a payment of bank loan, which is 200. Paid dividends, of course, as already told you. Now, net cash provided by financing activities will be the summation of all of those amounts. You see? Now, net increase in cash is equal to how much? We take this 1,100 plus 6 net cash, the net investing activity, which all of them have a negative sign. Only where we have positive sign is in financing activities. Means that we have operated in loan. That is the rationale. The company has operated in loan, but they finance at the end of the period to come up to cover all of the expenses issued used in investing and in operating. The finance come to cover. That's why we remain with 3,700 US dollar. Now, this agrees with the cash amount shown on the balance sheet. Yes. The statement of cash flow is useful because cash is one of the most important assets of a corporation. Information about expected future cash flows are therefore important for decision makers. For instance, Big Dog's bank manager needs to determine whether the remaining 6,000 US dollar loan can be repaid, and also whether or not to grant a new loan to the corporation if requested. The statement of cash flow helps inform those who make these decisions. Yes, you see, they can pay back. They remain with 3,700. So, not due to the financial statement. An essential part of financial statement are those the notes that company accompany them. Yes, these notes are generally located at the end of a set of financial statements. The notes provide greater detail about various amounts shown in the financial statement, of course, or provide non-quantitative information that is useful to users. For example, a note may indicate the estimated useful lives of long-lived asset or loan payment term. Example of note disclosure will be provided later. Yes. Transaction analysis. Let's move on transaction analysis and double entry accounting. The accounting question is the foundation to accounting. Yes. It shows that the total assets of a business must always equal to the claim against these assets by creditors and owners. The equation is expressed as assets is equal to liability plus equity. Assets are economic resources owned by an entity. Yes, all right. The liabilities are a creditor's claim on assets. Yes, those are obligations. Now, equity is owner's claim on assets. That is what we owe as our own. What we owe plus what we own. So, when financial transactions are recorded, combined effect on assets, liability, and equity are always exactly offsetting. This is the reason or the rationale that the balance sheet always balances. Yes, hope this one is clear. Each economic exchange is referred to as a financial transaction. For example, when an organization exchanges cash for land and building, incurring a liability in return for an asset is also a financial transaction. Instead of paying cash for land and building, an organization may borrow money from a financial institution. Yes. The company must repay this with cash payment. Yes. The cash payment in the future, the accounting question provides a system for processing and summarizing this sort of transaction. Accountants view financial transaction as economic event that change a component within the accounting question. These changes are usually triggered by information contained in source documents such as sales invoice and bills from creditors that can be verified for accuracy. The accounting question can be expected to include all the items listed on the balance sheet of Big Dog at January 31, 2023 as follows. We have assets. Assets, I have told you that there's comprise a current asset and non-current asset. Now, We under current asset, we have seen all of them. Even in Excel, I have shown you clear. I will not back on this. But liabilities. Under liability also, we have current liability and non-current liabilities. We have bank account, unearned or unrealized profit, unrealized. Unearned is equal to unrealized. Loan and payable revenues. Now, on equity, we have share plus retained earning, which is share is capital. Retained earnings, the earnings. Now, under liability, let us see here. Liability, we may be having liability from a bank, which is loan. We might be having liability from accounts or from creditors, which is payables, unrealized revenue or unrealized profit. Yes, they are the same. Now, if one item within the accounting equation is changed, then another item must also be changed to balance it. In this way, the equation of the equality of the equation is maintained. For example, if there is, I'm going to show to illustrate you the general framework, how it works. For example, if there is an increase in an asset account, then there must be a decrease in another asset or a corresponding increase in a liability or equity account. Yes, this shows that there is equality in there is equality in the essence of double entry accounting. There is an essence, there is an equality in the essence of double entry accounting. The equation itself always remain in the balance after each transaction. Yes, they balance each other. The operation of double entry accounting is illustrated in the following section. I'm going to show you so that we can understand it very, very, very clear. You see, we have those transactions. We are going to see, allow me to understand this. We are going to see how which one affect each other, and the equation still balance. The equation is still balance, even though there is a transaction which cancel each other. There will be no effect on what, on our double entry concept. Yes. Now, on 1st January, Big Dog Coward Corporation issued share of amount to 1,000 share to Bob. Means Bob was the owner, but he bought the shares. Yes, costing 10,000 US dollar cash. What is the effect? Cash increases will be used where in operation. Remember, in cash flow, those 10,000 will be used in operation. Already we have cash to operate. Yes. Now we have a capital of 10,000 already. When we have cash, we will be having capital. Equation balances. Go. Now, the second transaction. We are going to see step by step how each transaction cancel each other and the equation still balances. The second transaction, Dog Coward Corporation borrowed 3,000 US dollar from the bank and deposited the cash into the business bank account. Now, he borrowed the cash, means the cash increases. Yes. Remember the cash book in the journal, the prime entry. Where we started. We in a prime box, prime entry. When we have in the cash book, we have 3-column cash book. Cash in hands or cash in hands, of course. Cash at bank, and there is a contra entry. But the two main works together is if we have either cash, it should be either in the at cash or in the at bank. Now, when we borrow money, our cash, either at bank or in hands, will be increasing, which is part of current asset. You see, there is asset, and asset we have increased it 3,000. You see? Now, uh, come back. What happened to the liability? And we have seen that the accounting question equal that assets equal to liability plus equity. As simple that the equation is balanced. Asset is equal to 3, liability is equal to 3. So the equation is balanced. 3 is equal to 3. Yes. Now we continue at every single thing. Now let us an amazing transaction number 3. On January 3rd, on January 2nd, the same day, the corporation purchased the 3,000 US dollar of equipment for cash. Remember, those amount we have seen here, the same day, the company borrow this cash, withdraw them, and they buy what? They bought equipment. So means there will be asset is equal to 0, and equity, what happened? Now we don't correlate the transaction, but I wanted you to show the other thing, because the correlation will come to to a balance, which make a general. The balance only is the master balancer. Yes, this term is sound weird. Trial balance is the master balancer. This here, by entering a journal, you are not able to balance. You only deal with individual transaction. That's why what we see here is our only single transaction balanced. Because here we have 0. You see, 0 is equal to 0. Nothing to adjust. You don't complicate yourself. You enter data as long as it shows balance. It's okay. You see here, the transaction number 4, the corporation purchased a tow truck for 8,000 US dollar, paying 3,000 US dollar cash and incurring an additional bank loan for the balance. Yes? Means we have in our pocket, we have 3,000, but we need a truck, 3,000 US dollar, but we need a truck of 8,000 US dollar. What we done, we go to bank, they lend us the missing 5,000, then we come up with our 8 to be able, we come up, we take our 3 from cash, we add those 5, then we bought our truck at 8. Now the accounting question matter is our transaction being balanced? Then it's okay, it's balancing. How? You see, the truck is an asset. Truck is a non-current asset, you see, of 8,000 US dollar. Within total assets, there is under current asset we've withdrawn 3. Now total asset remain with 5. Now, but also we have borrowed some amount from bank, which stand it out that we will remain here in this line only. We will be remaining with 5, and those 5 are equivalent to those 5 in liability. This transaction is also correct. Now We can move on that transaction purchase. We have there are the prepaid insurance. We paid on our fifth. We paid the 2,400 for 1 year insurance. Now, prepaid insurance is an asset, but if we paid them with cash, they cancel each other. They offset. They are offset. No problem. We have seen that while offsetting transaction are occurred, there is no problem. It's the same on six transaction on 6th January 10th, the corporation paid 2,000 US dollar cash to the bank to reduce the loan outstanding. Yeah. To come up with well-being of us and the stakeholders. We pay bank, but by paying bank, we borrow, we borrow to, we withdraw 2,000 from our cash to pay 2,000 at the bank. This transaction also is correct, is obey the double entry rule. Now, the corporation received 400 US dollar as an advance payment. Yes, this is current. Advance payment is current liability, yes, because it's an earned revenue or an unrealized profit. Remember, should be subtracted in profit, we will see them. Yeah, yes. Now, cash, we have received the cash for unrealized profit. Okay, this transaction is clear and obey the entry rule as well. Transaction number this of 8, number 8, yes, January 20th. Automobile repairs, yes. This one is clear. We did what? Let us cheat. Repair of 10,000 were made for customer. 8,000 of repair were paid in cash, and 2,000 of repair will be paid when in the future. Means our customer, we made service to our customer. He was unable to pay all due debt. He paid only 8,000. But he say he guarantees us that he will pay us later. Now, we take these 8 first, considering the remaining 20 to 2,000, sorry. Then we take into our account that we still have equity equal to that amount. Because the source of them, we have cash and the account receivable, which is current assets also. Now our equation is balanced. Only we deal with the transaction. For everything, we have to deal with transaction. Now, the corporation paid the operation tax expenses for the month as follows. Rent, salaries, supply expense, truck operating expense, regarding to oil and gas, all of them were on credit. Now, we did what? There is a decrease in the assets, cash, because expense cause net income. Remember, the corporation paid operating expense for the month as follows. Yes, 1.6 for rent, 3.5 for salaries, suppliers, operating expense. Now they said what were for cash is that 700 for truck operating was on credit. It's only that what they have told us is only the truck was on credit. Other means other way expense cause the net income to decrease and the decrease in income cause equity to decrease. There is an increase in the liability account payable. There's impact on the equation. This is very understood. What they mentioned here is only that $700 was for credit, which will be only there. Means all of these are equivalent to 7,100 are paid in cash because they were not mentioned that they were on credit. On credit here was 700. Now, on January 31st, transaction number 10, I think it's the last one. Yes, it is the last one. Dividends of 200 were paid in cash shareholders. These dividends were paid. So we take our um, our cash, we pay dividends. When we pay dividend, we reduce our capital because one in retained earning as part of equity is being reduced. So they cancel each other. We take cash, but we take also equity, a part of retained earning. Now, what is the general view? We are going to see the general view of this workflow we have done. Then we are done. Yes. These various transactions can be recorded in the expanded accounting equation as shown below. Now we have seen a single one by one transaction under accounting equation. Now, what all of those transactions we have seen, what their impact on financial statements or financial position of the business. Now let us see. You see, these are under asset. Yes, we have received 10,000. Remember in our assets, yes, we have received the 3,000. Every single transaction, this 400 is for unrealized profit. Everything here we have seen them. Yes, the way they have been, not that everything should be recorded and they have impact on what, on the total, as I told you before. Yes, the total equity is being affected by every single transaction here. Yes, we have seen 400. Like that coming in the maybe before we got there. They have we have seen them in our informations. Before we analyze the transaction, sorry, there should be somewhere by cooking information. Where are our cooked information from? Yes. Yes, almost here. Sorry, a little bit. We've seen them 7, 8. We've seen somewhere in our data cooking 200. Yes, there is 400 profit that we didn't realize. Yes, I will just show you where they are from. Of course, they should be somewhere. Unrealized profit of 400. Unrealized profit, we've seen them for us to be sure that this information is no problem. Let us cook them in a quote. Those. This is the increase, increase in 100. Yes. Now you see, there's a every accounting question. You see, here there is. This cash, even though it was unrealized, but it will increase the equity. Yes. Now you see, these are those transactions. I've seen them. I was taking a simple example, but everything should be greatly understood. Now, this 400 as unrealized profit will be there under unrealized profit as well. What I have demonstrated here is that every single transaction should be reflected in the double entry, both in debt, in assets, but also in credit. Yes, we have 10,000 shares. We have them here. Yes, we have 3,000 shares. We have them at bank. Yes, we have those amount, the borrowing. We have borrowed the money. They should be reflected. We remember by buying a truck, but this truck is if there are five of there and three of cash, which the difference gives it to five. So the transaction cancel each other. This is the general framework. Now let us see the overall. These numbers are used to prepare the income statement. Which numbers? Remember, there are amount to which we have used the in retained earnings. In retained earnings, we have some of the amount of gaining. Yes, there's 10. All of those amount that were just brought, they profit for every single transaction. Yes, and there's a you have seen that some of amount these 200 are just the dividend we have paid. There's 700 we have paid for. There is someone who have paid for. Yes, for yes, there are account payables. There are account payables. We have seen them. There is 600 transaction that we recorded because they will be using in preparing the income statement as well. You see, where is 161? But remember, another thing that you have to remember is that when you have finished the part of additional information, no need, you can use your journal because every transaction you have already demonstrated them here in your journal while working. It's better for you to don't bother yourself by coming back to this. You see revenue. Yes, this revenue, rent expense. Now, these are the expense. The 116 is for rent expense and the salary expenses. Remember, they will reduce the overall revenue. That's why these will be used in our calculation under income statement because they will reduce the profit. This is what they were showing us. This is what they were showing us here in our general flow. Those data are just for income statement. There's one only. There's the ones that we have been transaction. These columns are used to prepare the statement of changes in equity. Which one? There are 10,000 shares and there are 2,000 profit from operation. Now remember, we have initial capital of 10,000. You see? We have initial capital of 10,000. Accounting is sweet when you do not when you are not bored. When you are not bored, you become familiar with this. Yes, 10,000 were initial capital. Now, after our operation, profit from operation is 2,000. They are telling us there's a profit this 2,000 will come an additional to retained earning to be added to the initial capital we have invested. That is the general framework, my friend, which is very clear. Understand that is the general. This is the best tool of accountant. Hmm? When you are accountant, you are able to demonstrate this accounting equation as this, you are physically fit, mentally fit, and able to operate. And now you can produce any accounting report out of this data. This is what we are going to see. Because I have shown you the way of data cooking in Excel. Now we have managed to make the ledger. This is like a ledger we have seen. We have just mounting the journal and what. Now the final thing is just producing a report, financial report. Nothing is here. Yes, you see the balance are balanced. 19,100 are all of those amounts. You see, all of those amounts you see in the assets, total assets. Because the current asset we've seen some were offsetting and others were compromising, but they are equivalent to those in current and non-current liabilities as well. Thus, we move forward in our reports. Great. The task is done. Transaction summary, we have done all of them. Now, let us see our product. This is the product of what we have done. Yes. We have balance sheet. Yes. That comprise of those cash, account receivables, prepaid insurance, equipment, truck, which is a total of 219,100. We have current liabilities. We have bank loan of 3,000 plus 3,000. We have account payables of 7 because we have borrowed. Now we have unrealized profit. Those are 400 at which they give us for prepaid rent, if I remember. Now you add them, you make a summative. You come to share capital of 10,000. We have started the business of share from that person who bought them, and we have gotten net profit of those. It was 2,200, but we subtracted how much? 200 of giving for room. We have paid dividend of 200, which gives us the result of the remaining only with 2,000. Thus, we have seen then the revenues. No. So this is the balance sheet, and don't you want you this part? Don't see this part. This part is just for profit. Now you see this part is equivalent 19 from current total liabilities and total assets are just equal. The component of the equity are shown in the balance sheet. Yes, you see. Before we move to the statement of change in equity, let us move first on revenue, statement of revenue on right side. Yes. Let me hide this and come on review with profit with this one, 'cause for you to be, let us move on income statement. You see, we have revenues. We have a repair of 10,000 US dollar. We subtract those expense. We have rent expense of 1.6. We have seen. We have salaries of 3.5. We have supplies. Yes, we have produced it. Truck operation. Yes. Now, the total expense amounting to 7,800, which we have already seen them, I recall, in our working. You remember, net income is 2,200 US dollar. Net income become part of retained earning. Yes, but you see, before yes, it is a retained earning, no problem. Now let us move to changes in equity. You will see that it is not 2,000. You see, this is 2,000 is there. This is what I was showing you. We will just remember to subtract the dividend of 200. This is what I have shown you before, that everything is correlated to each other. You may subtract it there, or you come here and remember to subtract any change in equity. When you don't show them, when you don't produce this statement of change in equity, if this statement is ignored, remember to do those changes right here in this statement of financial position. This means that your profit, your retained earnings may be 2,200, but also you should do, when you add those 2,200, you should take into account that yes, you have already produced revenue of those amount. Yes, let us show it here. Under share capital. When you show 2,200, you will not pay to that dividend, and in your cash you will add 200, so that your current your state means but you as accountant, you are reliable. Better you produce this statement. Otherwise, you come up here in your statement of income statement, you only show 2,000. Yes, because here the statement of financial position is clear, and even here is clear. What it illustrates for us is that better for you to do not do what? To do not ignore every statement while producing your reports. Yes. Now, allow me to stop by here. The thing is clear. Accounting period is fiscal statement are prepared regularly, interval usually monthly or quarterly, and at the end of each 12-month period, in 12-month period is carried a fiscal year. But there is one thing that I'm going to end with, is that for the listed companies, corporation listed on stock exchange are generally required to prepare interim financial statements, usually every 3 months, primarily for the use of shareholders or creditors, because these types of corporation are larger and usually have many owners or users. You require more up to date financial information, because those company on listed stock exchange, they need updated information timely. For them, it is better for them to produce even weekly, but regulatory under regulation, they require 3 months may be prepared. Yes, for them to be so those company may be required to work interim income statement before the year end. They may produce. That is something we have to be sure that no, don't be misleaded when someone tells you we prepare financial statement for 3 months. Yes, for the listed companies, for them to be the owners, user require more update for data information. These help them to take informed decisions. Where to buy shares, where to sell shares, yes, they help them because they take informed decisions. Now, but in statutory, every company should prepare a financial report at the end year. I thank you for your kind consideration up to the end, and I hope that if you are a beginner for our website, and if you are an upcoming accountant, this foundation module introduction first is here for you. Next, we will see the chapter 2. Let me show you this chapter is on the yes. This chapter 2 will be the accounting process. We will see the accounting process in our next video. Allow me to end by here. We will continue in our next session. Guys, thank you. But it does not matter if we make a subscribe. Was this video useful? I hope so. If it was useful, make a subscribe button there and like us. Share with an accountant now for this wonderful milestone in your personal learning perspective for you to grow and to even increase your skills either in a educational way or in your workplaces. I am Ange Fabrice Muhi. Subscribe, share, and like our videos. See you in our next tutorial. Thank you. I love you. I like you. And I enjoy when you were happy with us. Better next to be with you.